Hello, I'm Terrence McNally, and welcome to today's podcast. Recently, the show featured an interview with Paul Gilding on his book, The Great Disruption. Gilding's the one who says it's time to stop worrying about climate change. A global crisis is already upon us, and it's not simply about climate or even emissions. He believes we're witnessing system breakdown. Our global economy and society exists within a context and a framework of natural limits, right? And the limits of cheap fossil fuels, of plentiful food, of drinkable water, and of debt, among others, are squeezing us and causing pain. The question is how quickly we will cease denial and how fully we will mobilize to deal with all of this. As you know, I'm always searching for individuals and organizations and ideas that accept reality and then are a positive force for change. Today's guest, John Fullerton, has spent a career at the highest reaches of the financial world, including as chief investment officer at JPMorgan. He is now the founder and director of Capital Institute, Capital with an A, Capital Institute, which describes itself as, quote, a non-partisan, transdisciplinary collaborative space whose mission is to explore and effect economic transition to a more just, resilient, and sustainable way of living through the transformation of finance. Now, that's a big, bold, and daunting mission, and I'm eager to learn how they plan to do that and a sense of their progress so far. John Fullerton, as I said, is the founder and president of Capital Institute, a collaborative space that's working to transform finance. He's also the principal of Level 3 Capital Advisors, LLC, whose investments are primarily focused on sustainable regenerative land use, food, and water issues. Previously, John was the seed funder and CEO of Fullerton Capital Management, and prior to that, managing director of JPMorgan, where he worked for over 18 years, ending, as I said, as its chief investment officer. Fullerton is the creator of the weekly blog, The Future of Finance, on the Capital Institute website, capitalinstitute.org. Welcome, John Fullerton.
Terrence, great to be with you.
Okay, I like listeners to get a feel for the people behind the work and the ideas that we talk about. So could you talk about your path to the work that you do today? Flesh out that brief bio from your point of view, from how it felt going through it, and feel free to cite mentors, turning points, moments of decision, that sort of thing.
Sure. And first I need to make a slight correction in your introduction. The term Chief Investment Officer of JPMorgan has taken on a new term recently, as I'm sure your listeners will recognize. I was actually the Chief Investment Officer of a division of Morgan called Lab Morgan. So just to set the record straight.
Very good. Okay.
So really, to respond to my story, I really need to go all the way back to my undergraduate experience at University of Michigan. I had been an international relations major and took a course called the Economics of International Relations. And that course really changed my path away from thinking about law school and toward Wall Street. The thesis of the course was that economics and finance would determine the course of international relations in the future rather than politics. And it's kind of interesting to think back on that thesis today. The thesis proved to be correct, although the way in which it's played out is certainly not what the professor or I was thinking at the time.
And what was that time, by the way, just to set that?
So I graduated in 1982.
Okay, so this is in the end of the 70s going into the 80s.
Right.
Someone foresaw this. Okay.
Yeah, which is pretty prescient as you think about it at the time. So that gave me the idea to try to find a job in one of the leading banks in the country, and I was lucky to be offered a job in what was then called Morgan Guaranty Trust Company in their commercial bank management training program, which was sort of a mini MBA, if you will. And so I started work at Morgan in the fall of 1982, and very much with this idea of learning finance as a path toward contributing to economic development and a more peaceful and prosperous world economy. And it's sort of one of these funny things that happened on the way to the ball. I landed in the bank very soon after that. The interest rate and currency swap market were created, and really that was enabled by the introduction of personal computers and spreadsheets on bankers' desks. This is a time when I I went through college and even the training program without a personal computer, and in my first job on the bank, that's when Lotus 123 was started appearing on desktop computers, and so that enabled this new creative business called derivatives to really take off. And before I knew it, I was in Tokyo. Not before I turned 30, I was in Tokyo running JPMorgan's Asian swaps business, mostly because the people that were older than us didn't know how to run computers. So there was sort of a 10-year gap there where a whole group of us ended up in jobs that we were nowhere near mature enough to have. And right at a time when the derivatives business was booming in response to the deregulation, particularly in the Eurobond markets, the freeing up of exchange controls and the growth of the Eurobond debt capital markets. And so it was a very heady time, and derivatives became the creative area and the exciting area, and frankly the very profitable area of the bank before derivatives really became a dirty word. So I rode that wave, if you will, for a while. Very exciting. 3 years in Tokyo, a year and a half in London, and then back in New York, and moved into different parts of Morgan's capital markets businesses, and really lost track of the original reason I went to Morgan in the first place, to be honest.
Yeah.
But it was exciting and seductive, and success sort of has a way of keeping you pursuing it, and so that's where I was. And really, it was not until 1995 I remember the beginning of what I describe as sort of a rolling epiphany, and I had just become a global business manager, and so I was theoretically on top of the world and should be happy, and it happened to be Father's Day, and I had to go to Singapore to meet the troops in this new business I was running, and I was kind of miserable because I was in this airplane on Father's Day. And so while I was luxuriating in first class in Singapore Air, I looked down at the newspaper that I hadn't had time to read much because I had two young children at home. And there was a story there was a story in the right-hand column about how messed up the subsidized federal low-income housing system was. And so that spoke to me about, problems in the world that needed attention. And then in the right-hand column, candidly, there was an article about when Walter Annenberg gave away his fortune to, I believe it was 3 or 4 schools, Brown University, I forget the second one, and then a nursery school. And it struck me right then that, that the kind of classic model of work your career up a corporate ladder in order to be successful and then to become a philanthropist was lacking and not a path I wanted to follow, and that there was plenty of people with capital in the world looking to do good things with it, and rather than wait until I was 70 years old and become a philanthropist, I wanted to engage more directly in some good works that were really the reason I went to Wall Street in the first place. So it took me another 5 or 6 years to muster up the courage to leave the bank, and I had many exciting experiences between then. It wasn't like I was miserable, but really it was the merger with Chase that frankly gave me the courage to walk away with no real plan in mind, and in part because all my stock options vested as a result of the merger. And so I left the bank in 2001, a few months before 9/11, and then to continue the story, the first time I was back downtown in New York after I left Morgan was on 9/11, and I was in a subway. I'll never forget the face of this man that came in the subway and announced that they had just flown a plane into the Trade Center. So I immediately went up to the street. The train stopped at City Hall, and I went up to the street, and there I was standing basically at the end of the Brooklyn Bridge, watching just after the second plane hit. And that obviously shook me, like it did everyone that experienced that firsthand. And so by the time I got home and saw my kids, I think I was well on my way to sort of a very deep introspective period. And I spent literally years reading books and thinking about what was wrong with the global economic system and the banking system and the world of finance that I had grown restless in. And in that process, I discovered the ecosystem crisis that your prior guest, Paul Gilding, talks about and writes about very better than I can. And it really kind of was a wake-up call and a shock, because as a banker and a finance person, it became very quickly my conclusion that if the economy is driving us off this cliff and finance fuels the economy, the root cause of all this problem was me and people in finance. So that's how I got onto this path.
Very good. That's the voice of John Fullerton. He's founder and president of Capital Institute. You can learn more at capitalinstitute.org, and you can find his blog there, The Future of Finance. And you blog pretty regularly.
Yeah, I try to do once a week.
Very good. When you witnessed or experienced 9/11, as you did, standing on a street looking up, how did that experience and the transformation you were going through intersect?
Well, my reaction, certainly part of my reaction was like many people's, was one of anger and outrage. But frankly, I think there was a stronger reaction, which was sort of a questioning of why was this happening, and what was the bigger message that it maybe subconsciously was trying to communicate to us. And so I sort of immediately went on this sort of what does this mean kind of mission, and would talk to people and read things where I was searching for the meaning of it beyond the horrible act itself. And so I think it spurred me to dig deeper on the questioning around economics and finance than I might have otherwise.
Mm-hmm. Because I was going to say, that is not an environmental, event. That's not a financial event. But it basically, I guess what I was looking for, and I think what you said, is that it just intensified sort of the sense that something's wrong.
Yeah, something's deeply, profoundly wrong.
Very good. This eventually leads to the founding of the Capital Institute. How did it come into being? That is to say, once you saw that the area in which you had expertise, in which you had experience, was actually, if you'll pardon the expression, a leverage point.
Yeah.
In what was wrong and in turning this battleship, this aircraft carrier, towards the right direction. How did you then go about setting it up?
Well, it's interesting. I spent a number of years exploring the idea of investing capital in alignment with social and environmental objectives, this field called impact investing, which was a good sort of playground, if you will, and a way to try out and learn and think about this. But it was really not until the financial crisis hit. And, I would talk to people about my preliminary conclusion that there's something deeply wrong with finance, not the ethics or the behavior that became, so corrosive, but at a more systemic level, at an architectural design level, really boiling down to compound interest being in conflict with a finite planet. And I would say these things to people, and they'd look at me like I was nuts, particularly my finance friends. And so I kind of just kept plodding away and concluded I hadn't figured out a way to talk about it yet, or I hadn't figured out a way to really understand it. And then when the financial collapse happened, everyone suddenly thought I wasn't crazy, and I was more prescient than crazy, even though in many ways the financial collapse was not really directly related to a lot of the issues that I'm most concerned about. It is in a certain sense, but it really was not caused by anything related to limits to growth or system limits in any direct sense.
Let me jump in there, because I think where they do intersect is that the financial crisis, it seemed to me, had a great deal to do with the the mistakes in two principles, the principle of risk and the principle of incentive.
Mm-hmm.
And it seems to me, I mean, as I look at the financial crisis, it really seems that's where we were way off. But if I looked at the Iraq War, I would see the same thing. Mm-hmm. Misinterpretation of risk and incentive. And if we look at the big thing which is driving you now, which is that we are embedded in a planet of limits, again, risk and incentive seems to me to be crucial.
Yeah. You know, you're absolutely right, and I often say that the financial collapse should be understood as our canary in the coal mine for what happens when complex systems collapse. And certainly the financial system did collapse. It just happened to be bailed out, but it certainly was in the process of collapse when the bailout occurred. And the real lesson from the financial crisis, and this is consistent with what you just said, is, again, to look at it for the lessons it teaches that are broader than what kind of regulation do we need, what's wrong with bankers' ethics and whatnot. It really is a lesson in complexity and risk and what happens when complex systems collapse and how to design systems so that they're more resilient so that they don't collapse. And that has a direct translation to thinking about the ecosystem, which is, if we accept the limits to growth thesis and Paul Gilding's very well-written book, we're somewhere on our way toward a much more profound collapse if we don't shift course.
Right. And one of the things, it seems to me, in terms of misinterpretation of risk in the different areas I found, was that a tendency of the, if you will, the best and the brightest, or as I think someone wrote about Enron, a book called The Smartest Guys in the Room, right?
Yeah.
To act on best case scenario. Certainly, that's what was going on with the over leveraging and the idea that the housing bubble would go on forever and no one would pay the price. Certainly, the war in Iraq, similarly, and this notion of really smart people acting on a best case scenario rather than considering the downside if they're wrong and what the worst case scenario is. Yeah. And it seems to me people just don't like to think about the worst case scenario when one looks at the big issues of the limits of nature, whether it's resource or climate change. That's where the worst case scenario has to play a role.
That's a great point, and I certainly agree with it. And unfortunately, this wasn't the first time when we had to learn that lesson. One of the experiences I had at Morgan, I was I don't know if you remember the long-term capital management collapse.
Oh yeah, yeah.
Filled with Nobel Prize winners who are very smart people, and I was actually Morgan's oversight committee person, meaning I was their representative to manage the workout of long-term capital. And the mistakes made there are eerily similar to the mistakes made in this recent financial collapse. I mean, it wasn't subprime loans then; it was different instruments, but the same unwillingness to look at real downside risk and unwillingness to accept that a remote possibility of something really horrible happening can happen, and in finance often does happen. For reasons that are it's a little bit technical, but there's almost a precondition that if something really bad can happen, it will happen in finance, and it's largely to do with the fact that the market gets positioned in such a way that you have a herd effect once the dam breaches. You have a self-fulfilling prophecy. And yet, that happened 10 years earlier, and we never really changed our approach to risk management, or better said, to uncertainty management. And we can't, one of the lessons about long-term capital that we didn't learn is that there is uncertainty, and you can't manage uncertainty. And we confuse uncertainty with risk, which we think we can manage. So it's a long way of saying I agree with your comment.
I'm Terrence McNally. I'm speaking with John Fullerton, founder and president, Capital Institute. You can learn more at capitalinstitute.org. So then you decide that actually, well, let me ask first. You spend some time in impact investing. Talk a little bit about that. I think I've referred to it in programs, but I have yet to actually do a full show on impact investing. So this concept may be new to people.
Okay. Well, it's an interesting. It's in many ways a new name for an old idea. The idea of aligning investment capital with explicit social and or environmental purposes. Think of low-income housing, think of community development finance. The entire community development financial institution industry in the United States is an expression of this idea of impact investing. But it's become a space now. The Rockefeller Foundation did some great work several years ago to create a sort of an understanding and a language and an approach to it, and launched something called the Global Impact Investment Network. And now there are conferences you can go to where entrepreneurs with new business plans that are aligned with social and environmental purpose. The concept of triple bottom line businesses is another bit of language now. And so this is a booming space. The preeminent conference now that you can go to is called SOCAP, which stands for Social Capital Markets. They have a conference in San Francisco each fall, and there'll be over 1,000 participants, entrepreneurs and investors looking to essentially mobilize the great parts about the capitalist system to attack some of the world's leading or most pressing challenges. And the concern I have about the idea is that it's now being promoted even by some Wall Street banks as a new asset class. And the issue is that all investment has impact, both positive and negative.
Yeah.
So in my judgment, we do ourselves a real mistake if we think of it as a standalone asset class and then don't think about how the rest of the capitalist system is working, and sort of view this as a small little side water or backwater of capitalism, and everything else keeps going as planned. And one of my central premises of our work is that all investment and real investment, not speculation in securities. So the investment decisions made by corporations, by governments, and by individuals are really the bridge to the economy we'll have in the future. So it matters very much both the quantity of investment and the quality of investment, meaning do we build bicycle factories or do we build ammunition factories, for example, or Hummer factories.
And yeah, I like what you're saying, that all investing is impact investing. And there's something a bit patronizing about saying, oh, good little investment over there.
Exactly. And it's viewed by many in the foundation world as a new tool for philanthropy, which again, I think that's a great way to think about it from the perspective of a foundation, but we can't miss the point that the tens of billions of dollars spent by major corporations every year has massive impact, and feedback loops that keep us moving on this unsustainable path.
Right. Yes, I know. I often look at all the good things people try to do and then sense that there's a 24/7 juggernaut that never sleeps.
Exactly.
That's moving inexorably in the opposite direction.
Exactly.
So I think we got to the point where you learned some in impact investing. Let me ask one other question in impact investing, which is, is there something they sacrifice so that they can, in other words, what we often hear is legally, corporations in the U.S., not everywhere, legally, their fiduciary responsibility is to maximize the return to shareholders, and anything else is at least secondary to that. Mm-hmm. And so if one says, well, we're going to have a positive impact, do they sacrifice something? Do they alter something in their rules or regulations? Or do they say you're not going to get as much as quickly in return?
Well, that's a great question. We could talk for an hour on that issue alone. So, first of all, you're right. There's this issue. The legal definition of fiduciary duty for boards of directors is very much a contentious subject. there's an interesting development that's happening in this space in response to that, which is an idea of an alternative corporate form.
B Corps.
B Corps, right. So there's a nonprofit called B Corporation that is working legislative initiatives at the state level to create an alternative to a C Corp called a B Corp, which explicitly states that the directors can and should look beyond just shareholder value and should look at stakeholder concerns and stakeholder value in addition to shareholder value. But with respect to the question about what happens, should investors be expecting comparable returns, financial returns, while they achieve these social and environmental objectives, is a vexing question, and there are as many opinions about that as there are practitioners. I think it's probably fair to say that there are some projects and investments where there's sort of a win-win-win, where the stars align in such a way that there's a business opportunity that generates at least as appealing financial returns as in alternative sort of comparable risk investment opportunities, while at the same time achieving real either social or environmental, or in some cases both, kind of returns as well. There's a group of impact investors that call themselves financial first impact investors, where they'll only look at a project where they can assure themselves that they're not sacrificing financial return in order to achieve these other objectives. And then there's another group of impact investors which explicitly state that they're more mission-first impact investors and are willingly and intentionally sacrificing some financial return, even though they still view the investment as an investment and expect to get a return, or at least a return of their investment back at some point in the future. So it's a big, hairy question with lots of debate and discussion around it.
Right, and it also sounds like it's very much a continuum.
Yeah, exactly.
Right, the financial first on one end,
Yes,
philanthropy on one end, and the financial first folks on the other, and
exactly.
In the rest.
And there's a concept that Jed Emerson has talked about for years now called blended value, with the idea that it is a continuum, just as you said.
And let me. I raised the point in my question that the definition, the legal definition and responsibilities of a corporation are not the same in every country.
Right.
And I'm correct in that, aren't I? My sense is that in Germany, employees are much higher in the return chain than they are here. Here it's shareholder first, and in some other countries, the customer has a higher role, and so on. So it is not that a corporation is a corporation worldwide.
Correct, and there are many different forms of ownership. You may not be aware, I wasn't until recently, that this is the International Year of the Cooperative. And I'm speaking at a cooperative conference, but there's apparently more people working in cooperatives in the world than there are working in multinational corporations. And a cooperative is either typically an employee-owned business, democratically owned, or a customer-owned business. So that's just one alternative form of ownership. And then, obviously there's private companies, both in the conventional sense of family-owned businesses, but also privately owned companies that are owned by private equity firms. And once you have a privately owned company, you can adjust the governance rules however you choose. But your basic premise was correct. I think there's steep cultural differences between the degree of which a business is run for shareholders only versus a broader understanding of stakeholder interests. And certainly there's a European, and as you said, in Germany, there's much more of in fact, I think many German companies have a labor representative on the board of the company.
Well, actually, what I've been told and what I've read, I've been looking at this pretty intently over the last year or so, is that in Germany, any corporation with 2,000 or more employees, half of the directors are elected by the workers.
Is that right? Yeah.
And now their definition of director is a little different than our board of directors here,
yeah.
But it's the kind of thing that, as I have said so often, I don't even hear unions in America asking for that as a trade-off
Right.
when they give back, when they agree to change their pension plan or something.
Yeah.
In other words, something which is the norm in probably the most successful economy right now, Germany's, is not even on the table in an American negotiation.
Yeah.
Okay, so and I really appreciate, by the way, John, all you're willing to go with me on all these digressions, because these are the things that you were mulling about, thinking about, learning about as you got to where you are today, and what you learned on that journey is of interest, I think, to people who haven't taken that journey. So you have set up the Capital Institute. What is it? How does it exist as an entity, and what are your methods? What do you hope to accomplish?
So it's a nonprofit that I founded a couple of years ago, really out of my garage, so to speak, and very much motivated by this idea that it was time and just to begin. So I didn't have a business plan. I had a vision of what it was meant to be, but it wasn't started with a real clear strategy and execution plan. It was started because I think there's a Goethe quote, something about the first step is to begin. I forget the exact quote.
Yeah.
So I began, and it's evolved into I use the language collaborative space. So I worked very closely with both practitioners working on real world projects on the ground, and some of those I participate in personally, and some of them I study and learn from. But also with transdisciplinary academics. And one of the key insights about our work is that the answers to sustainability lie in looking to nature and natural systems. So I spend more time and have learned more from ecologists and a branch of economists called ecological economists, probably most noteworthy being Herman Daly, but also some of the really the big shoulders that I'm standing on are people like E.F. Schumacher and Hazel Henderson, and there's a lot of people that have been thinking about how economics needs to work to more mimic how natural systems work, and so I try to engage with there's probably 50 people that are working around this idea of a new economy that's more in alignment with how natural systems actually work at a systemic level. And what I try to do is bring a deep knowledge of finance and focus on the implications this has for how the financial system should be architected and how the practice of finance needs to shift itself. And we have a very small team. There's 3 of us, and we put out a weekly bulletin that has my sort of blog ideas, which are typically comments on some issue in the news cycle, but looked at through the lens of the Capital Institute and this idea of transforming finance to a system that serves a sustainable economy. And then we do some research projects. We've actually just launched a very large research project called Economics, Finance, Governance, and Ethics in the Anthropocene. The idea being that we're in this new epoch called the Anthropocene, where man's impact on the planet is actually determining the course of the planet. And this is, again, a collaboration of a number of scholars around what the implications of being in the Anthropocene mean for these different fields. So there's probably 8 authors working on it together, and that's up on our website now. It's just an example of a sort of more in-depth research that kind of project we do. And then, longer term, there's a desire to translate this into public policy. We've begun work on that, and again, in collaboration with people that are working on the public policy front. And then finally, there's a need to translate this into really a new curriculum. And I believe that within the next 10 years, our finance textbooks as well as our economics textbooks will need to be rewritten, and what's being taught in the business schools needs to change quite profoundly, and particularly in finance. And so I'm on that bandwagon. I give talks and I'm engaged with some professors, finance professors in certain business schools to begin to develop that new thinking, in particular with a project with Bard College here on the East Coast, which is setting up a new MBA in sustainability, and we've agreed to help them develop the finance curriculum for that MBA program.
Okay. Now, how would you compare or contrast Capital Institute with the Institute for New Economic Thinking? Rob Johnson has been a guest on the program, and, what's the difference? What's the overlap?
Interesting. So, first of all, full disclosure, Rob's a friend and actually on my board, so I hope there's some overlap. And I would say that their work is moving more toward our work than where it started. I think their work, the other big difference is that they're extremely well endowed now with
by George Soros.
And others.
And others, that's right.
So they're now a major foundation, really, giving out grants to academics. And their mission, as I would describe it, I'm sure Rob would say it better than I, but it's very much to create an alternative path for economics scholars apart from the conventional path that exists in universities, and motivated more by the financial collapse than and a conclusion that obviously there must be something wrong with our understanding of financial markets. Whereas our start was really much motivated, as I said earlier, by a recognition that finance is fueling our drive toward an ecosystem collapse. And I think when INET started, they viewed ecosystem issues like climate change as quite distinct from the economics challenge. And but now I'm comforted to see that their sustainability is very much on their agenda, and I think they see the connections between these more than maybe they did when they started a few years ago. But I'd say the major difference is that we're very focused on the conflict between exponential growth on a finite planet on the one hand, and a financial system that's grounded at its core on compound interest and a debt-based financial system. And we're less interested in, developing new theories that explain why financial markets behave the way they do.
Mm-hmm. Yeah, one of the things I would think is that yours, in some ways, has a simpler distinction, because it really does boil down to what the outcomes that unfold from that conflict between exponential growth as the essential rule of your financial system, and limits to growth, the rule of our actual planet.
Yeah, the laws of thermodynamics, which are laws, not theories.
That's right. That's right.
Yeah, and I think it would be fair to say, I don't know, I don't want to speak for Rob, obviously, but I think most of the economists that are in the INET community, to varying degrees, don't question the notion of exponential growth of economics. They're still in the camp of we need smarter growth, we need alternative models for intelligent growth, but they haven't concluded that growth itself is incompatible with a finite planet.
Right, and one of the things if I were to describe what they're about, is to bring the realities of human behavior to some extent into economics. That obviously human behavior is not acting according to the assumptions.
Exactly.
And what you're saying is
George Soros is, his key to his personal success has been that he figured that out long before any of the academics did, and traded very prosperously on the back of those insights.
And what you're saying is that human behavior is embedded in culture, and human behavior and culture is all embedded within natural systems.
Correct. And that financial markets are just tools. They're not the end in themselves. We need to tame the financial markets, but they're really a sideshow in the much more profound challenge, which is, how do we operate an economic system that is for the last 200 years presumed an assumption that happens to be in conflict with the laws of physics.
Yeah. Oh, let me share one thing. I've interviewed Herman Daly, who you mentioned is one of the real fathers of
absolutely, and one of my heroes.
Yeah. Oh, absolutely. And the story of his leaving the World Bank is just a wonderful little anecdote that I will share, which is that they were putting out, the World Bank was putting out some sort of a brochure on sustainability, and there was an illustration in it, and it was an illustration that depicted the economy. And he said, well, there should be a frame around this picture because the economy exists within the limits of the planet.
Right.
And it went back and forth, and the brochure went out without a frame, and he left the World Bank not long after.
Interesting, yeah.
Yeah.
He's been really, I mean, I said I spent years reading books, and his book,
well, there's The Common Good.
The Common Good was one that I literally was up all night reading because it just spoke so much to the truth that I was intuiting but hadn't been able to figure out, and so he's terrific.
Yeah. So let's talk about one very specific thing, which is a financial transaction tax. You are one of the signatories to a letter signed by finance professionals in favor of a transaction tax, and I'm just going to read a quote from that letter. The primary role of financial markets is to raise investment, allocate resources efficiently, and mitigate risk. However, much of today's financial activity does not contribute to these goals. Now, again, that is short of the limits of the planet, sustainability, and so on.
Right.
But as a tactic, a current tactic, could you describe where that stands and why you're involved?
Yeah. Well, you said it exactly right. It's a tactical move that's completely in alignment with the more strategic direction that I would support. So, and it happens to be a policy that's in play. And so I've used it as an example of a policy that Capital Institute should get behind and use our systems approach to support and bring hopefully some sort of financial sophistication to the argument rather than a kind of left versus right, pro-tax versus anti-tax, free market versus regulated market mentality, which of course is the dialogue that most of this debate occurs in. But the basic idea is not new. It obviously is, James Tobin is famous for talking about the need to throw some sand in the wheels of markets and or sand in the gears of markets. Keynes himself supported a modest tax in this sense for the same reason. And what's happened is that the debate today has been captured by an argument about whether efficiency always trumps everything else in markets. And again, looking to natural systems, what they teach us is that there's often a trade-off between efficiency and resiliency. And the high-frequency trading, which is kind of the extreme form of short-term trading, literally thousands of trades per second, is confused as being liquidity and therefore making markets more efficient, when in fact I think the evidence is overwhelming that this hyper trading activity is actually very destabilizing to markets and also destructive of trust in markets. So at a time when this country and many countries are experiencing profound fiscal imbalances, to have a tax that's used as a rifle shot to actually improve the performance and the true effectiveness of markets as tools to serve the needs of capital raising as opposed to playgrounds for computer-driven speculation is a proverbial no-brainer policy in my mind. And given the huge growth in the volume of trading, even though some of it will undoubtedly be diminished as a result of the tax, the revenue figures that can flow from even a modest tax are not insignificant. So
now let me just since again this may not be something in which everyone's conversant. When you say modest, you mean really modest,
right?
Right.
Like
we're talking 1/100th of a cent or something.
Right. I mean, there's different proposals out, but think of it as 10 basis points, meaning 10/100ths% that you would pay. So if you bought a share of IBM and the price, you'd pay an extra 0.10% when you bought it, and you'd pay that again when you sold it. So if you're a personal investor, you would, and you held IBM for a 5-year holding period, the total return you would earn over those 5 years would be indistinguishable whether you paid the tax or not. But if you were a high-frequency hedge fund trading thousands of shares per second, that 10 basis points begins to add up very quickly and would in fact make many of these trading strategies uneconomic, which is exactly the outcome I would favor as being actually beneficial to markets. And I would disagree with a number of economists who would argue that any trading volume enhances efficiency and therefore is good. So that's really the crux of the debate.
Right.
And the letter, just so you know, the purpose of the letter is that this exact policy is being debated in Europe right now. And so this was intended to be a message that said, even though our Treasury Secretary hasn't come out and supported a financial transaction tax, nor has he explained why he doesn't support it, there are many people in America who understand finance quite deeply who support this as a policy measure. And so please have the courage and go ahead and lead the world to a more rational capital markets by having a financial transaction tax, which, by the way, already exists in a number of markets, including the United Kingdom. They have something called a stamp duty on stock transactions, which is a form of a transaction tax.
And in other countries, in certain markets, and if you could, what has been the effect in terms of this the fear thrown out there that it will cripple the market, hobble the market?
Yeah, the principal argument is that efficiency is good, and this harms efficiency, and therefore it will harm growth. And I've written a number of pieces on this. If people are interested, it gets a little bit complicated, but there's a number of blogs I've written and given some addresses on this. But the gist of it boils down to, will this damage liquidity, and if so, how much, and if so, does that actually harm the real economy? And there's a whole bunch of issues that get confused there because we're talking about the liquidity of the secondary markets for securities and the efficiency of secondary markets in securities. We're not really talking about the efficiency of the capital raising process itself. And again, it gets pretty technical, but suffice it to say, if Warren Buffett decides to invest in Goldman Sachs at the height of the financial crisis, his decision to do that is unaffected by a transaction tax of 10 basis points. And so that's, a real investor providing real liquidity at a time when liquidity is very much in need and valued. And I think it's self-evident that a small tax would have zero impact on a decision like that. But that's the gist of the argument is around potential impacts on market efficiency. Yeah,
and what I also want to point out is that one can peg that at a point where the impact on growth is agreeable, let's say, and the income raised is valuable. In other words, at a time when we are when our economy has shifted so greatly from manufacturing to services, and then we found out by services they actually meant finance.
Yeah.
Right? So much of our productivity, if you will, so much of our effort, so much of everything is wound up in that can begin to carry a bigger share of the load of financing the investments we need as a country, which then goes back to the original reason for finance, which was investment.
Exactly.
I mean, I had a talk with David Kerp. I don't know if you know who he is. He deals in children's issues, and has a wonderful book called Kids First, in which he lays out kind of 5 big ideas that we should do to change the lives of children, which would be of great benefit to this whole country. And I said, that talk about children, that's an investment. How about pegging a certain portion of the investment, getting an investment tax, a transaction tax, and putting a certain percentage of it toward children, because that's the real investment, and another portion toward clean tech and adventurous, new innovative industries and so on, and it makes so much sense.
There's lots of good uses for the money,
absolutely,
including reducing our fiscal deficits. But to your point, Bill Gates came out in favor of a financial transaction tax with the idea of allocating, I believe, some of the money toward third world development. So same idea.
Yeah. Okay. Finally, we've got about 7 minutes. You in your sort of mission statement on the website, you suggest that you're looking at 3 big questions. So I'll throw your own 3 big questions at you and say you've got about 7 minutes to talk. What would an economic system that operates within the physical boundaries of the biosphere while more equitably serving the needs of people look like? How must the practice of finance evolve in order to fuel that transition? And what would the purpose of capital be in such a system? So just whatever you want to chew on that for about six and a half minutes.
Okay. Well, we haven't answered the questions yet. That's why we're still working. So it's an unfair question at this point. But I think we're beginning to get some clues. And again, not we Capital Institute, but we a group of people collaborating across the world around these same questions. I think on the economic system question, there's little doubt, in my mind at least, that we've taken this notion of globalization too far. And again, globalization was a search for efficiency, and it turns out that in natural systems, if we look to them as our teacher and our model, they tend to be more place-based, so that the shift in the economic system that is already underway will be one that better balances more regional and place-based economic activity with this idea that everything is going global and there will no longer be such a thing as a place and a place-based economy. And that has a number of benefits. One, it recycles wealth in communities, so that allows one to address numerous social problems that have resulted from globalization. And secondly, it reduces the energy footprint and the material footprint of shipping stuff all around the world all the time. So there'll be, it's a term one of my colleagues uses is we need to discover thrift in entropy, meaning the use of energy, and a more regional or place-based economic system, or a better balanced one, will certainly be part of that answer.
I want to jump in very quickly. I've given you very little time, but just one thing that occurred to me as you were saying that is for people to know kind of in terms of these answers, what you're doing is you're looking to sort of your principles, and so you look, what does nature do? And am I correct that much of conventional economics doesn't look at nature; it looks at machines?
Yeah, in fact, it's in a little secret that very few people, myself included, until I studied this, are aware of. Modern economics is actually grounded in Newtonian physics, which is a mechanistic view of the world, which has been supplanted by a whole different scientific understanding, both in physics and in biology, of how the universe actually works.
And yet, this model of how we invest ourselves and our fortune that's based on that still sticks with it. Yeah.
Exactly.
Yeah.
Okay. And the invisible hand is a very it's sort of a mechanistic law that was assumed to exist, but never never validated in science. So.
Yeah.
The other principle I would say at work, which I'm very confident is the path toward the future economy, is the idea of a regenerative economy. Mm-hmm. Again, nature is regenerative, and so much of our economic system is actually degenerative, meaning we use raw materials that are non-renewable, and then we release them into waste, whether it's into the atmosphere or into the rivers or into the trash piles. And nature doesn't have waste, and so we need to shift our entire economic system into one that's regenerative, just the way natural systems are. And that's true both in terms of our ecosystem function, and I'm involved in a really important project with the Savory Institute around regenerating the grasslands, but it's equally true around regenerating social capital in our cities and communities. And again, we're involved in a great demonstration project of that in Cleveland called the Evergreen Cooperatives, which is using Jane Jacobs' idea of anchor institutions being the source of energy. So their purchasing power in a community is, in a sense, free energy for the local economy. And what they found in Cleveland is that there was $3 billion being spent by the local hospitals and universities, and none of it was being spent in the local community. So by harnessing the power of that free energy and recycling it in that community, you can convert to a more regenerative economy in that location. And they happen to do it using a worker cooperative model borrowed from the Mondragon co-ops in Spain, so that the wealth building effect of these new businesses that are serving the anchor institutions is spread around the employees rather than just flowing to the capital that sponsors these companies.
Great. We've got to close it at that, but I think people can begin to get a sense of it. So if this is something that interests you, go regularly to the website at capitalinstitute.org, and you'll see that there is a big article on the Grasslands Project. It's a big article on the Cleveland cooperatives, and you'll see the kind of things that they're dealing with. The website where you can learn more, as I said, is Capital, C-A-P-I-T-A-L, capitalinstitute.org. You can listen to this week's conversation and many others anytime during the week by linking to the podcast. You can sign up to have it delivered to you weekly either at my website, TerenceMcNally.net, or aworld@justmightwork.com, or at iTunes. You can sign up at my website or by emailing me at temcnally@mac.com to get a weekly announcement telling you who's going to be on, what we're going to talk about, and 2 or 3 articles about the issues we'll discuss. And finally, thank you to John Fullerton. Keep up the good work.
Thank you, Terence. Great to be with you.
Very much. Bye-bye.